You're listening to the Tax Insights Podcast, where the professionals at Hawkins Ash CPAs break down complex tax topics into bite-sized how-tos. If your product enters another state, or you have a remote employee working in another state, you may have tax liability to states other than the one your business is in. Failure to collect and pay the appropriate tax can lead to additional payments, interest, and penalties. In this episode, Jeff Dvorachek, a tax partner, shares the information business owners need to determine their sales, payroll, and income tax liabilities to other states.
Most businesses operate in their home state, but did you know that if they sell product in another state, they may have a tax liability in that other state? And this may be true even if they never set foot in that other state. And, as states are looking for additional revenue wherever they can find it, they're actually looking for these businesses.
So they can tax you even if you've never entered that state?
In some cases, yes, because as long as your product enters the state. So today's conversation is going to be really broad, just to give the business owners a way to recognize if and when they may owe tax to another state.
So what kind of taxes then are we actually talking about?
We're actually talking about three different taxes: sales tax, payroll, and income tax. Now, your business may owe sales tax to a state if you ship a product to that state, even if you never enter it. So this is a result of the 2018 court case, South Dakota versus Wayfair. Now, your business may also owe payroll tax if your employee spends time in that state, or if you hire someone that's, working remotely, which quite a few businesses are doing, because this happened a lot during COVID. Or the third thing is you may owe income tax. And this is a little bit harder hurdle to jump, since you actually have to have a physical presence in that state.
So let's go back then to sales tax. Walk us through this.
Yeah, the Supreme Court ruled back in 2018 that if your business ships product to another state, even if it's by a third-party carrier such as United States Postal Service, UPS, FedEx, you will owe sales tax in that state. Now, it's just like when you sell product in your home state. If you're required to charge sales tax to your customer, then you would be required to charge sales tax to your customer from that other state. Now, the saving grace here is that many businesses have to do quite a bit of sales in order to be taxed by that other state. The threshold in many states is about $100,000 worth of sales into that state or 200 transactions. But each state is different, so you're going to want to kind of keep track of how much sales you do to other states.
So how is income tax then different?
Yeah, in order to have income tax nexus in a state, you have to have a connection above and beyond just shipping a product to that state. So this is a higher threshold. This is a result of like a 1992 Supreme Court case where they said a business needed to have either a physical location or presence in that state. They needed to have employees in that state. The company would have to have inventory in that state, or they have to deliver a product into that state on their own truck. So not that third-party carriers like we talked about with the sales tax earlier. So if a company has any of these, there's probably a strong case that they're going to have to pay income tax in those states.
So will a company end up paying more tax if they have to file in multiple states?
In most cases, no. So this will not be an additional cost to the business owner. Really what happens is they pay a similar amount of total tax. It's just split up differently between the states that get it.
So what if a company should be paying taxes in another state, but they don't?
This is really a big issue, much bigger than people think, because states are getting better at finding companies that are working in their states or doing, sending product to their states. So normally a state has about a 3 to 4 year statute of limitation where they can't come back at you if they find out that you were, having sales in the state without filing a return. But if a company never files a return, that statute never runs. So a state can literally go back to the beginning and assess tax, interest, and penalties. So it is actually a pretty big deal.
Jeff, a lot of great information each and every week here in Tax Insight. How do listeners, how do business owners, how do individuals connect with the team over at Hawkins Ash?
I would go to our website, which is hawkinsash.cpa, like us on Facebook, or follow us on YouTube for more quick and entertaining tax tips.
And we'll talk to you next week.
This has been Tax Insights, presented by Hawkins Ash CPAs. Learn more online at hawkinsashcpas.com. Hawkins Ash CPAs. Part of your business, part of your life.